Hello, and welcome to another stock analysis on Stock Market Palantir. Don't forget to subscribe and drop your comments. Now, let's go hear our analysts.
Welcome to the Stock Market Palantir. Today, we are going to talk about NU. We're looking at New Holdings Limited, NYSE, ticker NU, which has really transformed itself from just a disruptive startup into a systemic financial ecosystem in Latin America.
Right, and we're talking about a company that now serves over 118 million customers. The market cap is already exceeding $80 billion, with the stock trading around, $16.70 right now.
Exactly. And anyone just glancing at the chart can see the tension here. The stock's been locked in this really tight, volatile range between $16 and $18. And the stability, or maybe stagnation, sits right next to an incredibly high price-to-earnings ratio. It's hovering around 32 times trailing earnings. This is what I'm calling valuation friction. It's this massive pull between Nu's world-class operational engine and the external forces that seem to be holding its price down. I think friction is the perfect word for it. The market is clearly struggling to rationalize a 32 multiple when, traditional global banks are trading in the single digits. So, the central question for us, for any investor really, is this. Is Nu's premium valuation justified by its unmatched operational efficiency and its hyperscaling potential? Or is that valuation just structurally capped by some really severe macroeconomic headwinds and, frankly, some complex market dynamics?
Well, my position is pretty firm on this. I believe the intrinsic, fundamental engine of this company absolutely justifies the premium. And I think that engine is ultimately going to prevail over what is, in my view, temporary external noise. Nu's valuation is fundamentally anchored in its proprietary digital banking flywheel. Their unit economics simply defy the legacy banking models we've been studying for decades.
Okay.
I mean, look at the evidence. Their cost structure gives them an unprecedented competitive moat. The monthly average cost to serve per active customer has stabilized at a globally elite level. We're talking around 70 to 80 cents. This lets them profitably onboard and service demographics, especially low-income customers that incumbent banks have historically just ignored because the economics never worked. That ultra-low cost translates directly into immense operating leverage. Their efficiency ratio is under 30%. Just think about that for a second. If a major US or European bank hits 50%, they are celebrated as a market leader.
It's an incredible number, no doubt.
It is. And this efficiency drives net profit margins consistently above 40%. On top of that, their engagement model is working. They're shifting from just a supplemental app to being the principal bank for their customers. The activity rate is climbing to 83%. And the average revenue per active customer, or RPAC, has surpassed that $12 to $13 mark. And that's all fueled by successful cross-selling of insurance, new invest, even crypto. The fundamentals aren't just good, they are screaming a hyper-growth compounder narrative.
That is a very compelling case for their operational superiority. But, and this is a huge but, it almost completely overlooks the mathematical compression that's being forced on those cash flows. I mean, regardless of how world-class their internal engine is, the stock is currently being held down by external forces, specifically Brazilian macroeconomic policy and the mechanics of global trading. These forces mathematically compress its present value and they cap its price action. The primary issue, as I see it, is what I'd call the Selic stranglehold.
Okay.
Brazil's benchmark interest rate, the Selic, has been held at a punishing 15%. Now, this isn't just a headwind, it fundamentally changes the valuation math. In any credible discounted cash flow model, this high risk-free rate acts like powerful gravity. It imposes a punitive discount rate on every single one of those future cash flows you just praised. And this high-rate environment, it simultaneously elevates the risk across their credit portfolio. We've seen the non-performing loan ratios, the NPLs, rise, hitting 4.7% in Q1 2025. This tightens the whole credit environment and it weakens the net interest income engine. So the institutional positioning we see just confirms this caution. External macro risks are for now outweighing that internal growth.
I accept the mathematical weight of the Silic rate on a traditional DCF model. It's certainly a major obstacle if we look at new like a static traditional bank. But are we really valuing new based on fixed 5-year projections? I mean, my challenge to your argument is that the premium PE multiple is paying for their ability to sidestep that traditional model or at least to endure this environment with unparalleled resilience.
Well, endurance is one thing, but justifying a 32 times multiple today is another. Let's talk about that NII engine. Yes, it grew 62% year over year in Q1 2025, which is respectable, but that growth is being hampered by the 15% rate. That's a structural barrier forcing NUA to shift away from aggressive, high-margin unsecured lending toward lower-margin secured loans just to mitigate risk. The kind of credit expansion you need to justify a 32 PE, it's just structurally difficult until that rate regime changes.
I see why you frame it as a constraint, but I'd argue that the operational advantage, that sub $1 cost to serve, is precisely the weapon that allows new to endure this temporary macro storm better than anyone. They are built for a higher for longer reality. And furthermore, that high Selic rate, counterintuitively, it actually provides a short-term funding benefit. New's cost of funding is incredibly low. It's around 90% of the CDI, the local interbank rate. So they're effectively locking in cheap capital right now. This allows them to stockpile capital at an advantageous rate, ensuring they have the cheapest, most abundant funding pool, ready to lend aggressively the moment the central bank inevitably starts to cut rates. They're positioning for the cycle turn.
That is a strong counterpoint on their positioning. Using the current environment to build a liability spread advantage is smart. However, it's still a waiting game for shareholders watching the stock bounce between $16 and $18. So if we agree the silly gravity is a persistent, present weight, let's talk about their other growth pillar. Doesn't their massive expansion into Mexico and Colombia fundamentally change the long-term risk equation? Doesn't that give them the runway to eventually escape Brazil's gravity?
Absolutely. The geographic diversification is critical. It provides a buffer against Brazil's volatility. Mexico, in particular, is the key. Nu is actively positioning for principal bank status there by applying for a full banking license. Now, this administrative step is crucial because it unlocks the portability of payroll accounts. Gaining access to payroll is the key to massive, sticky revenue and cross-selling potential in the region's second-largest economy. This isn't just incremental growth. It's a strategic pivot designed to dilute the reliance on Brazilian policy risks over the long haul.
I acknowledge the strategy is brilliant. Targeting payroll in Mexico is a great move. But I'm just not convinced that diversification alone neutralizes the persistent issue of currency risk, which continues to undermine the whole narrative for institutional investors.
So how exactly does the FX translation risk impact this expansion?
It's a constant drag. Look, concerns over Brazil's fiscal framework are chronic, and that leads to volatility and depreciation in the Brazilian real. Since Nu reports its earnings in US dollars, every single time the real depreciates, even if Nu is killing it on customer acquisition locally, that operational success gets translated into slower, depressed reported USD growth. This FX translation risk is a persistent technical headwind that just frustrates investors looking for clean, predictable quarter-over-quarter dollar growth. It puts a constant asterisk next to their operational reports.
I see your point about the quarterly noise from FX. It makes forecasting harder, no doubt. But if investors are buying this as a long-term compounder, shouldn't they be looking past the daily FX noise and focusing on the local operational velocity, which remains exceptional? The stock is paying for the option on these massive untapped markets. Okay, let's move on to where I think this friction is most visible in the daily trading action, the market microstructure. This is where we see that mechanical valuation cap being enforced, day in and day out. The dynamics of how the stock trades are definitely worth interpreting.
We have to look at the opaque mechanics of the market, specifically the consistently high off-exchange short volume. Sometimes people call it dark pool volume. Data consistently shows this volume often exceeds 30 to 40% of the total daily volume. I mean, we saw an extreme example where 41.42% of the daily volume on November 25th, 2025 traded off-exchange.
That's a critical data point, yes, though I would frame its interpretation of it differently. Why do you see that off-exchange volume is necessarily bearish?
Well, it strongly suggests that large institutional players are engaging in sophisticated hedging or maybe distribution without allowing the lit price, the price you see on the exchange, to break out of that $16 to $18 range. This institutional absorption reinforces the cap we're talking about. And here's the key technical point. We know this isn't some retail-driven short squeeze setup because the reported short interest is actually quite low, around 2.76%. This volume indicates a controlled institutional environment. It's hedging, not bullish accumulation.
I agree the volume is substantial, but we have to dissect it. New is an extremely popular retail stock. That means a significant portion of that volume is likely just the internalization of high retail flow by large brokerages.
So while institutions are active, yes, that persistent positioning in the $16 to $18 range could also be interpreted as providing a supportive floor. I'd argue that institutional interest is strong and patient. This is disciplined buying, maybe influenced by the Buffett-Shield narrative, with institutions accumulating quietly in dark pools to avoid spiking the price. It's not necessarily distribution aimed at capping the stock.
And that's the fundamental tension of microstructure, isn't it? Whether that absorption is patient accumulation or a careful distribution. I maintain the dominant force right now is the cap, driven by macro uncertainty.
Before we wrap up, we have to clarify one thing that has caused a lot of confusion, especially among retail investors: the administrative action with the Brazilian depositary receipts.
Absolutely. So many investors still mistakenly believe NU did a reverse split to maintain its listing, which is a major distortion of the facts.
Right. The so-called reverse split was in fact an administrative BDR restructuring event. It was a transition from level 3 BDRs to level 1 unsponsored BDRs in Brazil, which did involve a 6-to-1 exchange ratio for Brazilian holders. This was a decision driven by capital discipline and efficiency to cut administrative overhead. It had absolutely no bearing on the financial health or the listing compliance of the NYSE-traded shares. It was a sign of corporate maturity, not weakness, and that clarification is essential. But it reinforces the broader point. The market is hypersensitive to any structural noise, and right now, the macroeconomic and technical friction is simply overwhelming the positive operational news. Hence, the rigid valuation ceiling. So to summarize my view, NU Holdings remains an operational juggernaut. It's a true hyper-growth story. The stock price may be wearing a macro straitjacket right now, but the core fundamentals, that unmatched efficiency and strategic diversification, will ultimately force a justifiable re-rating once the macro tide turns. It's a question of time horizon, not fundamental quality.
And I'll reaffirm that for the present, the external friction points, the crushing weight of that 15% risk-free rate, and the institutional caution we see in the dark pools are the overriding forces determining the stock ceiling. The long-term potential is massive, yes, but the current trading action demands recognition of these structural barriers. The market is waiting for tangible proof.
Ultimately, the story here requires tracking both the incredible micro-level operational data, that world-class sub-30% efficiency ratio, and the persistent macro-level policy decisions, specifically that valuation compression from Brazil's high interest rates. It's a complex dichotomy, presenting both enormous opportunity and ongoing risk.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.